Okay, so hello everyone. A very good evening. Welcome to yet another beautiful episode of AIKI, which is of India Karega Invest. Let me see how I have a lot of you on the call already. So thank you so much for joining in, guys. And I know it's a Friday evening, and all of you are looking forward to the weekend. So thank you so much for joining us today to listen to this very wonderful topic that we have lined up for you. Today we're going to talk about the sectors which are going to be the next big thing in the next decade, right? I'm sure all of us really want to understand what would be the future prospects. I mean, it's a very interesting question, right? What's going to be the next big thing? Can we invest in those businesses today which are probably going to be the fang stocks of the next decade, right? Which is a sector that we should be focusing on. So should it be infra with the government putting in so much focus on infra? There's so much spending that's happening on infra. Then should infra be the sector that we should be looking at? Or will EV, that's electric vehicles, will that be the next big thing, right? I mean, we see such a big shift that's happening where people are now becoming very conscious of their choices, right? We have some of the reports which say that the EV market is expected to grow by 90% in the coming decade. Or will it be the tech enabled sector? So would it be the food tech, agri tech, ed tech, fintech? I mean, all these tech enabled businesses, are they going to rule the next decade? So, there are so many questions that all of us have in terms of which sector is going to be the next big sector that I should be looking at investing today so that I can really get those returns in the next decade, right? So, to answer all these questions, we have with us Mr. Chandraprakash Padiyar, who's a senior fund manager of equities with Tata Asset Management. And today he's going to enlighten us on this particular topic, where he's going to tell us about, which are the sectors that we should be really looking at in the next, say, 10 years. So welcome, Mr. Chandraprakash, and over
Thank
to
you.
you from here.
Thank you so much, Namrata, and thank you all for joining me on this presentation today. I have a a few slides that I've created for this discussion today, and post which we can do a question and answer session. So let me start sharing uh, uh, those slides that I've created, and then but Namrata mentioned the topic for today is is what sectors are there valid for the next decade. Uh, Before I go to the sectors, I thought when I created this presentation, I thought it is important that I give you a backdrop of where we are in a brief sentence, a brief few slides, and then maybe I'll take you through what I think can be relevant for investors over the next decade in terms of returns. So let me start sharing my slides, uh, and I hope this is visible, Namrita.
Yes, yes. It's visible.
Great.
It's
Okay.
visible.
Thanks. Let me start. Yeah, great. Thank you. So let me start. This is just a, I think it's not about a decade, but maybe a century or more where India will be relevant for economies in the world. But I want to start my presentation with this slide, and it's a very important slide. It gives you a perspective of where we are from an equity market perspective. This is a slide chart of a BSE Sensex right from 1991 till yesterday. And it basically tells you that if you are a big statement that you can make from looking at this slide is that if you had invested in this market and remained a long term investor without bothering about various episodes that have come by, which is 1990, in the early 90s, there was reforms in India. Lots of governments have come and gone. Lots of governments have changed. Good governments, bad governments, perception wise. Economies have grown fast, grown slow. Satyam episode, Lehman Brothers, financial crisis, everything that could go wrong or could go right has happened. And you can see that markets have consistently delivered good performance to investors. In fact, one kind of good thing about this chart is that when we were in 2008, for example, markets corrected by 50% plus in that 1 year when global financial crisis happened, and we were all very worried what will happen. Look at the chart today, and you see that 2008 kind of year looks like a small blip in the overall scheme of things, and that's very interesting. Why has it happened? Because economies grow over a period of time, companies grow, companies profitability grows, cash flows grows, and if you actually take a long term view, then it makes sense to remain invested. So that's I want to start I really like to start my presentation with this slide. It makes sense. So that's one part. The second thing is that before I go to where are equity markets or what does the next decade look like, it is important to give you a backdrop of where we are today from an economy perspective. Uh, and these are some of the slides that I thought, or some of the charts that I thought are relevant for you and me to consider for India as an economy or equity markets going forward. The first very apparent or very kind of a positive thing about the Indian economy is that after 17 years of back-to-back current account deficit, which means that we've had a trade deficit consistently of very high level, let's especially between 2012 and 14, where we have been typically an economy where we import more. We are 70% plus of our crude, for example, is import. We are dependent on imports, oil, which is for our vehicles and for our factories. The second is gold, and there are certain electronics, and those are things which we've been importing. So we've been large importers, whereas we've been less of exporters, and that meant that we are, when you have a deficit in trade, then you need flows. Either you do software and NRI remittances, exports, which help you in times of trying to uh, get dollar money to take care of your trade deficit. But at the same time, then you are dependent on FII flows, FDI flows, for your currency to remain stable, for your economy to remain stable, so that you can import even further going forward. And which is why this chart is important, that after 17 years of back-to-back being negative, FY21 and FY22, not so much 22, but 20 and 21 were a current account surplus economy. But more importantly, we have been a balance of payment surplus economy for some years, including FY22, which is the current year, which means that our forex reserves, and the bottom chart on the left is basically showing you how our forex reserves has grown to $640 billion. In fact, last 3 years we have added $100 billion to our forex reserves, which we kind of added in kind of in fact, last 1 year itself we added $100 billion, which we added between 3 years, over a period of time, cumulative. So which last 1 year has been very strong for our forex reserve addition. And one big reason is that our FDI flows, we have been seeing consistent increase in FDI flows every year. So we have been the highest level at $44 billion of net FDI last year, and which meant that our import cover for economy is as high 17 months in FY21. I remember in 90s, when we were 1991, 92, if you look at the data, we had import cover of only some 14 days. From 14 days to 17 months, we have kind of crossed a big journey actually. So basically, it tells you that Indian economy is comfortable. Our external position macro looks pretty strong. The other thing that is equally important is that since FY08, and FY08 is relevant, uh, last time we saw a peak in our corporate performance from a profitability perspective was in FY08. FY08, our corporate listed companies' corporate profit to GDP, which is the top left-hand corner chart, had gone to as high as 6%. And by the time FY20 came, also because of COVID, it got impacted. But this 6% fell down to as low as 1.8%, which means that for a period of almost like back-to-back 12 years, corporate India profit to GDP declined, and which is one reason why, if you look at the Sensex chart again, it will basically show you that between '08 and right up to 2020, our market average return was less than 10% CAGR. The reason why that was the case is that corporate India profitability was not growing. In fact, as a percent of GDP, it was declining every year back to back. And we had gone to an all-time low level of 1.8%. This 1.8% as a percentage of GDP has gone up sharply in the last 2 years. Q1 FY21 or Q1 FY22, actually, this number is 22, had already gone to 3.5%. And in fact, Q2 numbers, which were reported some time back, and we are now in Q3 numbers, the way the trend is, we believe that by the end of FY22, the current year, corporate profit to GDP will be as high as 4.5%. So from 1.8 to 4.5% is a sharp pickup in terms of profitability that we've seen from corporate India. And that is one big reason why you see equity markets doing well. So as we all know, markets are slaves to earnings. That's a very common saying in our markets, is that earnings, if they grow, stock prices follow. And which is why it is important to track that our companies are doing a good job in terms of profitability. And what has this done in terms of increase in profitability is that leverage or debt on the books of non-financial listed companies, which is BSE 500 I've taken here, debt to equity has gone down to almost like a 15-year low, from BSE 500 non-financial companies. And these numbers are as of FY21. My sense is that debt to equity would have fallen even further, in fact, very sharply in FY22 again. Uh, and at the same time, what is also happening, and it's an interesting phenomena, we are seeing businesses, and in spite of COVID, we are seeing industry after industry demand being stable or strong, which means that capacity utilization for various industries are moving towards 80% plus. In fact, steel as an industry demand is even higher. Cement demand is very high. Chemicals, pharmaceuticals, lots of sectors demand is even higher than 80%. Engineering goods, lots of businesses we find. Uh, Capacity utilizations are already moving towards 85-90%. The reason why I say this, and which is the topic of today, I now come to uh, where I see more potential for our markets. I'll come to various sectors which can generate good returns over a decade. But I want to focus my time in today's presentation in highlighting that I believe we've reached a time where manufacturing in India, or make in India, as our Prime Minister likes to say, is we are in a sweet spot. From a global environment, what is happening globally, geopolitics is playing a role, competitiveness of Indian companies in various sectors is playing a big role. I kind of, for example, let me give you an example. Mobile phones, all of us use mobile phones. Couple of years back, we used to be 90% plus import dependent. So every phone that we used to purchase used to be 90% plus imported out of India. Uh, Today, we have kind of, it's turned around on its head. In a very short period of time, more than 40% of our production in India is exported out of India. In fact, we are no more uh, uh, dependent on imports of mobile phone. In fact, we do assemble a lot of it. It's not 100% everything manufactured right from component to the full end product. But it's suffice to say that we have improved significantly because of our competitiveness, because of production linked incentives that the government is giving, because of ease of doing business that has happened in India, because of competitiveness, as I said, and because of geopolitics, more like anti China sentiments that are playing around in the world. We are seeing, and mobile phone is just one example, but let's say all motors, air conditioners, washing machines, small household equipment. Most of these things used to be imported earlier, and increasingly we are finding that everything is shifting to India from a production perspective. And this is what I want to talk about today: is that I think India is at a sweet spot or an inflection point where manufacturing as a segment is likely to pick up materially going forward. It's already, we can see these in numbers in sectors, various sectors, sector after sector. But I think the trend is only going to increase. What it means for our economy is that more jobs, manufacturing jobs. So India is never. So if you look at our history, we have been a consumption-oriented economy. Investments came and went by. So, for example, there have been periods like I'll show you here. In this chart, you can clearly see whenever manufacturing picks up or whenever capital formation picks up, let me put it this way: whenever investments or in new capacity being set up picks up, whenever investment in infrastructure and capital formation picks up, your GDP growth is very strong. So as you can see in this chart, There were years between '04 and '08, for example, where back to back investment in capital formation grew by between 13 to 19% every year consistently, which meant that, and we have a steady consumption growing as well, 8 to 10% every year. So a combination of that meant that our GDP grew 9% plus consistently back to back for many years. And basically, what it meant is that in those years, lots of jobs were created, salary increases were there, and real demand pickup was there across the board, and which meant that our equity markets was the best ever. In fact, I remember in those years, average profit growth back to back for corporate India was something like 24-25% CAGR. There, the old economy sector, which is capital goods, infrastructure, banks, financials, uh, these were the sectors which were the best performing part of the market in during that time, and these are all dependent on high growth in the economy, more job creation in the economy, high capital investment in the economy, and which is where and if you notice after '08 financial crisis, if in the same chart, uh, capital formation has been very weak. Actual investments, in fact, in FY21 we saw a very large decline, and that's why GDP also declined. But there is a silver lining, and we are seeing a very big change. One more thing that I want to say is, and maybe in this slide I can explain. Uh, Basically, we have a $2.7 trillion of GDP. 2 trillion is consumption, $800 billion for capital formation. But if you notice in this slide, you can maybe read it at your leisure at a later date. But one big clarification that I want to make is that out of this capital formation, real estate also plays a big role. And if you now think about it, over the last 10, 12 years, real estate has been very or maybe we can call it weak over the last 12 years consistently. A price appreciation was missing. Grow slowly and gradually, the investment appetite in real estate went away. Genuine buyers were only buying, and that too, they were limited. We had a very sharp inventory increase in real estate, and I'll show you in some slides later where inventory levels have moved significantly down. Ready inventory of real estate has come down. So we are kind of prime for a real estate pickup as well. You can see it in the equity markets. But I think real estate prices have room to pick up incrementally, gradually though, not aggressively. And I also believe that demand in real estate is here to stay. And we believe that when real estate picks up, and real estate, for example, in household capital formation, as you can see in this chart, out of $313 billion, real estate is 38%. Even in private, corporate, and public, there is a fairly large real estate component. And that means that our capital formation, not only because of capital investment by corporates, which will pick up, and government infrastructure investment will pick up, but even real estate will have room to pick up, and which means that I believe over the next decade, uh, I think we are in for a very decent economic growth consistent over a long period of time. There are obviously ifs and buts. There are risks which we can discuss if you want later. For example, crude prices, one big risk if it goes higher, or if we, let's say, if for some reason capital FDI slows down or FII flows slow down. Those are risks in our economy which we'll have to kind of, where there are political risks as well. But I believe where the way things are, we are at an inflection point from a growth perspective. This is one slide just to, there are three parts that I showed in this chart: public, which is government, private, corporate, and household. Let me start with the public first, which is the government side. Uh, Again, very interestingly, between 2016 and 2020, average government investment in infrastructure in India was very stagnant, was very stable but stagnant at around $130 billion a year. So there was very hardly any growth in government investment in infrastructure, which meant that the government side, which is as good as something like $191 billion of capital formation, was not growing enough, and that had its own impact on the economy and corporate earnings, uh, which this number is likely to grow at $170 billion and then 190. So we are in for a 10% plus investment pickup from the government side going forward. Uh, this is the slide that I was highlighting on real estate, uh, launches were higher earlier, sales were lesser. That number has changed materially. Now sales are higher, launches are lesser, and hence you can see in the ready to move inventory in Exhibit 3 in the bottom left corner of the chart, ready inventory across 7 cities had moved down from 803 billion to 490 billion. Uh, uh, so very sharp decline in ready inventory, and under construction inventory is also declined sharply, which means that uh, we are in for a real estate pickup as well. The other thing that I want to highlight, and this is in my opinion very important, is that ultimately everything boils down to money, money supply, cost of money. If you get enough capital at the right time, which means that if banks are willing to lend to you, lend to businesses and household at the right price at the right time, which means that money is freely available, then logically it creates its own cycle in the economy. But that kind of stopped sometime in 2018. It started That process started in 2013 itself when UPA 2 government in 2013, for example, our currency depreciated very sharply in that one particular year from 40 late 40s to 60s. A very sharp depreciation of the currency that happened because at that in that year we had very high inflation, high current account deficit, and money supply or FDI FIF flows kind of corrected sharply. Uh, since then things have so what happened in that year is that we had a new RBI governor, Mr. Rajan, new finance minister, Mr. Chidambaram, and they started kind of mending things. And then we had a government change in 2014 with the NDA government coming in. But in the initial years, between 13 and 18, we saw governments pushing banks to recognize NPAs. And by the time FY18 came in, uh, gross NPA for the banking sector had plus restructured assets had gone to as high as 12.8% for the whole sector. This number has fallen to a very sharp decline of something like 9.8% in FY22 Q1. And by the time FY22 ends, I believe this number will be something like 6% or lower. So it's almost kind of halving. So NPAs are halving. Banks have already provided for their gross NPAs now. So average uh, provisioning coverage is in excess of 60% for most banks. In fact, the largest bank in the country has a provision coverage ratio of more than 70%, which is a public sector bank. Which means that today we've reached a stage, and in fact, in between 18 and 20, if you remember, a large number of PSU banks had come into the PCA category, which is prompt corrective action category, which means that they were not allowed to lend incrementally, and uh, basically 25% plus of the banking sector was kind of stuck. They were not lending their deposits out in the system. So credit growth was very weak in these years, which meant that obviously economy will not do well, and equity markets were also suffering because of that. Things have changed. Most banks or all the banks have now moved out of PCA category. They can start doing business. Credit growth has picked up as usual. Corporate deleveraging also happened in that time horizon, as you can see in the chart. Equity markets have started doing well. All this means that money supply today is ample, liquidity is in plenty in the economy, cost of money is low, and credit demand is picking up when, as I was highlighting in my earlier slides, capacity utilizations have moved up, which means that there is this capex intensity which is going up in the economy. Uh, and a lot of companies are today sectors like chemicals, capital goods, steel, aluminum, all the commodity sectors, telecom, after these tariff hikes that have gone up, and Vodafone Idea choosing to take equity from the government or kind of convert some part of debt to equity from the government side. We are seeing these large sectors which can spend money on capex. We are seeing intention to spend going higher, export picking up materially. Uh, this is one slide for exim data, which clearly shows that capital goods imports have gone up significantly. Short cycle product sales growth has moved up to almost like 70% in Q4 21. Engineering exports have picked up to as high as $100 billion plus in a year. Looks like the way things are, this can be materially higher going forward. So we are in a phase where I think capex intensity will go up. And as I showed in the capital formation slide, whenever capital formation or investment in the economy goes up, GDP growth is likely to be higher. And in those years where credit growth picks up for banks and where provisioning coverage requirement goes down, it is logical to assume that uh, earning growth for corporate India will be strong. For example, FY22, the current year, uh, it it is assumed by consensus. I'm now referring to Bloomberg consensus. Uh, the FY22 profit for list BSE Sensex and Nifty companies is likely to grow by something like 38% this year, and on that base, another 15 to 18% next year. So we are in for a fairly strong profit growth environment, as is being reflected in the economic data as well, which means that we are poised for a sustained growth phase over the next decade in the Indian economy. And coming to the sectors in very brief, and then I'll stop for questions. I think, uh, and this slide, and I may be a contrarian probably, because the markets in the last 10 years, for example, if you notice, it was consumer oriented businesses which did very well in the initial cycle. Let's say between '09 and right up to 1920, uh, FMCG and consumer businesses were the leaders in the market, followed by IT. So last couple of years, we've been seeing IT and digital companies doing extremely well. And in between, there was this pharmaceutical rally for some time, but it fizzled out very quickly for their own specific reasons. But going forward, and this is where I would put my money on, is that I think we are in a phase where manufacturing activity is likely to pick up materially in India. Capital investment is already picking up. Production-linked incentive schemes. I didn't mention this in the PPT in terms of slides, but let me highlight that PLI schemes, production-linked incentive schemes, which the government has been announcing till now, that alone means that in the next 3-4 years, $25 billion plus of investments, capital investment will happen in the country from corporate India. Not only corporate India, but multinational corporations coming to India and setting up capacities. So I think we are in for a fairly good phase for capital good companies, engineering companies, capital good companies. The other beneficiary of this trend is obviously banks. Whenever you have high growth in investments, all of these companies do require funds, and banks provide those funds. These are early stages. I'm not so. In fact, last month alone, or November month, the data that we have for, and December will soon get, credit growth has finally moved towards 10% growth. We have been seeing 4 to 5% growth for a long time. Credit growth is now, so we are in a early phase of seeing a pickup in credit growth. My own personal opinion is that we will see healthy double digit banking sector credit growth, and that means that banks can start doing well. Incrementally, corporate India, as I showed, leverage is very low. So NPA situation is of the books now. Banks will do very well from a profit perspective, and that means that banks, and that's one sector which is still pretty attractive from a valuation perspective. The next sector, it's more a decade view now in terms of pharmaceuticals. I believe pharmaceuticals mm, have a very strong, obviously you need to be selective in the kind of businesses that you buy, but I think at current stage, valuations have, because of this correction that we've seen in the sector stocks over the last 12 months, valuations have become pretty attractive. And FY23-24 onwards, it is very likely to see, for at least for 2-3 years, very difficult to give you a very decade view in this. But it looks like that from that stage, earning growth for certain pharma businesses can pick up materially. So I would say pharmaceutical does make sense today. Digital, there are lots of new companies getting listed in the economy. There are lots of in the markets. There are lots of new businesses disrupting existing businesses. Lots of businesses benefiting from, let's say, everything going online, everything going on the cloud. And hence I've kept this as a theme for the next decade. It will always kind of, there are obviously, you need to choose your stock well and all that disclaimer remains, but I think digital is one segment, one theme that will remain there for times to come. And lastly, India is a consumption economy. We should not forget this. And it's just that between '08 and 2020, uh, consumer businesses had outperformed in such a large manner that valuations had become too high, which meant that there was a time gap or a period of consolidation that was required. So last 2 years plus, we are seeing consumer as a sector not doing so well from an incremental return perspective. But I think if I take a decade view, then consumption as a sector remains a good sector to focus on. So these are some of the themes that I mentioned. There are plenty of, see, the other thing is, and just to conclude, whenever economy does well, which leads to high employment growth and job creation and new businesses getting created and salaries levels going up and real estate doing well, whenever this trend or cyclical upturn happens, it basically means that equity markets will do well. But because of the economy doing well, almost every sector benefits. So it is not that I have mentioned these 4 5 themes which will only do well. This is a call only for a relative kind of return perspective. I think uh, everything should logically do well consistently, but relatively, I would bet my money on these 4 5 themes in a larger manner. So with this, I will maybe stop here, and uh, we can, if you have any questions, we can take that. Thank you.
Thank you so much. That was such a wonderful presentation. I mean, I so agree with a lot of points that you said, especially technology. I do believe, if in the next decade it's going to be all about technology. We're already talking about virtual reality. We're talking about artificial intelligence, and who knows what the next decade has in store for us in terms of, how technology is going to be the next big thing for us. So, of course, there are some questions for you. The first one being, with the increased focus on infra and industrial capex, will the metal and cement industry benefit highly?
So metals, just to clarify, metals is a more a global commodity, which is steel, aluminum, copper. They are significantly dependent on what happens in China more than India, uh, because China consumes close to 40 to 60% of any commodity, and metals are global commodities. So I would say that one needs to take a view on what happens in China more than global, to take a view on prices for metals. And metals are, as a commodity, metals are, from a stock price perspective, is dependent on uh, price levels or realization improvement for those commodities, more than volume growth, for
Mhm.
stock returns to come by. So my personal opinion is that it's a it's you need to bet on China as a, and which today, as we speak, is going through its own consolidation period of consolidation from an economic growth perspective. For example, the latest quarter GDP numbers that came out of China, the economy has grown by 4.1%,
Mhm.
which basically tells you that it's growing slower, and they are also in the phase where they are trying to control their environmental pollution in their economy, which means that they are in the process of cutting down lots of commodity businesses from a production perspective. And real estate there is kind of, if for example in my slides I showed, we are going to see a pickup in real estate, whereas in China they have after a strong pickup, they are now seeing a period of consolidation. So I would say metals may not be, at least I would say my personal opinion is that I don't think metals can sustain a sharp return performance as we've seen in the last 12 18 months. It's a good sector to be in, but we do be very very choosy. Not everything will do well. On the other hand, cement is a local sector. It doesn't, import export is very limited in this sector. And we are in India, for example, increasingly we are finding consolidation in cement sector. Also we are seeing capacity utilization, demand growth picking up, and capacity utilization moving higher. So there is likelihood of cement sector doing relatively better. So I would, yes, I think cement is a good sector to look at.
Okay, okay, sure. I think I'm sure that answers the question that was asked. Okay. So, after COVID-19, the participation of retail investors in the Indian stock market has increased massively thanks to internet penetration. What role will retail investors play in shaping up the Indian equity market going forward?
Namrata? I think we have a issue with Namrata's screen. Just wait for a couple of seconds, maybe. She'll come back again in a minute. Okay, so let me take the questions. I think I have the questions. Uh, the question was, which Namrata was asking, is given the passive investing in ETF. So basically, the question that she was asking, retail investors have increased massively. And what role can retail investors play in equity market in the coming, especially the young millennials? It's an interesting question. Uh, I think from a demographics perspective, India, and this is one of the plus point that India has, is that increasingly we are becoming a younger economy, and uh, the only challenge when I was young, for example, is that we tend to take a lot of risk. We tend to experiment a lot with new thought, new ideas. For example, when you look at the data, yeah, we have Namrata back. Namrata, I had started answering your question. Uh, basically, for example, when you look at the data, all these crypto or Bitcoin and blockchain related currencies, uh, I find a lot of interest not only in equity market but a lot of interest in the other asset classes as well today from the millennials. Uh, I would say that. Uh, my only and they will play a major role. Yes, I agree. I think retail investors, especially the millennials, will play a very, very high, strong role in the equity markets going forward. Having said this, I would say that uh, like there were certain mistakes when I made when I was young, which is that do your due diligence well. Don't look at trading only. Don't look for very high reward for the millennials. But yeah, since the question was that will they make a role, will they play a very large role? I would say platforms like Groww uh, have are making it easier for investors to come and invest in mutual funds and in equity markets, and I think they will play a larger role going forward as well.
Yeah. Maybe when we are finishing the session, right, we could just quickly brief up in terms of what are those few points that the millennials should keep in mind while they're investing. If you want, you can probably just tell us now quickly, like maybe they should invest for long term, look at having a diversified portfolio. What are those few, four, five things? Because, every time we do AIKI or any session with Groww, we have a lot of people who are joining that session for the first time. So even if we've done multiple sessions in the past talking about a particular thing, there's a lot of new people who will benefit at least from this perspective. So can you just give us those five things that people should focus on as new investors? Just those 5 points, that's it.
Yeah, so you said it rightly, Ramrata. And maybe I'll repeat it, but it's what I've realized is that ultimately, in any asset class, one is you have to take a long term view, but more importantly, you should realize that over a long period of time, you will make money to the extent that asset class has value up to the value that they have. For example, let's say I've been in this market for 21 years in equities. I've been following this equity market for more than 21 years. And in my tenure, the average profit growth for Indian corporates, and I'm referring to BSE Sensex Nifty,
Yeah.
has been something like 12.5, 13% CAGR. And
Mhm.
the average Sensex Nifty return has been something like 14 to 15% CAGR. What it tells you is that 14 to 15% CAGR is a very good return to be happy with.
Yeah.
And it basically tells you that the Sensex, which was 100 or something like that, is today 60,000. But when you compound at 20%, compounding is a very big thing. The longer you stay in
Yeah.
the markets, a 14 to 15% CAGR also makes a very large difference to your portfolio.
Yeah.
60,000 from 100 to 60,000 levels for the Sensex in 21 years or more, actually 31 years, is a very,
21.
very large number. So compounding is something
Mm.
that everybody should understand very well. And lastly, which is what I kind of indicate, is that don't go in for quick returns. Most people, I think, start with trading, and most people start and gradually they start with derivatives, option
Yes.
trading, because they get margin funding very easily.
Mm.
You can take larger positions. But unfortunately, I have never seen any large investor making their wealth on trading. You have to become an investor, which means that you have to take long term views, and that's how you create wealth. So these are some things that I will want to highlight.
Perfect. Perfect. Sure. Okay. So now, of late, passive investing products such as index funds and ETFs are, becoming a lot of they really a lot of investors are interested in passive investing, right? So, how relevant are these products in case of India, specifically for retail investors in the next 10 years?
They are pretty
Last 2 years,
relevant, I think.
yeah.
Yeah, they are, and increasingly they will become more and more relevant from an Indian equity market. See, today, for example, in passive fund, the overall AUM is not very large, and a
Mm-hmm.
large part of that AUM is from provident fund,
Mm-hmm.
which is investing in through mutual funds in the equity markets,
Yeah.
and out of the other part of it is decent part goes to the banking sector, because insurance companies are not allowed to invest in directly beyond a percentage in banks, so they indirectly invest through mutual fund in the banking sector funds. So you see ETF investing or index investing through large investors because of this, and hence you see a skewness from that AUM perspective. But I would say increasingly the way global thing and you would notice most asset managers, including Tata AMC, are launching their own index funds and ETFs across sectors, uh,
Mm-hmm.
one by one. Not so basically all asset managers are saying that we will not only be active managers, we will provide you as an investor all options to invest in. Whether you want an index fund or you want an ETF or an active manager, we are there for you. Which means, and when more and more funds come like this, naturally AUM will also come there, and naturally they will start impacting equity markets. So I think index investing will become stronger and stronger going ahead, and
Okay.
it's a good way to start investing for early investors,
So
people
it's
who
not
do
really
not.
just a short-term trend.
Yeah,
It's
it's a,
not.
it's a very long term trend, but more importantly I would say anybody who is first time investor in markets, uh, it is a very good way to invest through the Nifty index fund or Sensex index fund or banking sector fund. These are good index funds, or ETFs are a good way to start investing, to start learning about investing, and then over a period of time you diversify to other sectors and allocate more
Oh,
money somewhere else.
into active funds, yeah. Okay, okay, perfect, yeah. Okay, so there's an increased focus on sustainable themes such as ESG, investing, renewable energy, EV companies, and so on. So, do you think these companies which are operating in these sectors will be the wealth creators in the coming decades?
So, in fact, to be honest, when I was creating my presentation, when I was writing about sectors, I had written about alternative energy and clean energy and as a theme. But then I
Yeah.
removed that part from my slide is because as of today, these are early days. Uh,
Yeah.
it is difficult to think from an economics perspective. So, for example, electric vehicles as a theme or alternative energy as a theme. Uh, there is still technology is still evolving. Companies are still evolving,
Mm-hmm.
and it is not easy even today uh, to come out and say that these are the companies in this sector which are listed and which will benefit from this trend. It is so we are in the very early stage uh, from a sector perspective, from let's say an alternative energy or electric vehicle or an hydrogen ecosystem or a solar ecosystem. Everything it is still evolving. It is still being in the development phase. People are kind of acquiring companies for technology and trying to create capacities in India and all. So I think there will come a time when we will start focusing on this theme. But for an Indian equity market investor perspective,
Mm-hmm.
I think maybe 1 year more, 2 year more. We are going to be there, but not today.
Okay. So it's a little early to talk about it.
Early days,
Maybe
yes.
we'll do a session on just EV investing in alternate energy with you in a year or two, and then you'll have a slightly more a bigger perspective on this sector, maybe.
Hopefully, yes.
Okay. Uh, yes. How about the insurance sector? I mean, maybe I think people are just asking questions on topics that you've not covered, right? So we have a lot of questions around sectors that you've probably not touched upon in detail. So, any thoughts on insurance sector in the coming few years?
So there are two parts to insurance. One is general insurance, the other is life insurance, and the third is reinsurance. There are three parts actually listed in the markets today. uh, I think general insurance, in my opinion, is the most sustainable growth part of the economy from a long-term perspective, especially health and health
Mm-hmm.
insurance, and it makes sense to consider businesses. However, in Indian markets, uh, anything good tends to trade at a very high valuation. So I think that's something that you and me have to kind of tackle from a return perspective. But I think from a sustainable growth perspective, my pecking order would be the general insurance space, followed by life insurance, followed by reinsurance. And
Mm-hmm.
within those themes, there are in every part of the insurance segment, there are individual companies which are doing extremely well. So if you choose your business well, I think there is room to make money in reinsurance, general insurance, life insurance, everywhere. But from a sustainable growth perspective over 10-year period, I would prefer more general insurance over life insurance.
Okay. Okay. Uh, Many tech-based companies or say digital companies are getting listed on the Indian Stock Exchange. How many experts have, there are lost experts who have a very mixed opinion about these companies. So, what are your thoughts about the long-term viability and role of tech companies in shaping the Indian economy?
So it's a mixed bag. There are businesses which do not have a business model to showcase today from an financial business model, from a profitability perspective today. However, they are garnering market share aggressively. Uh, and given the phase in the markets, equity markets today, the markets are willing to accept them as new IPOs and give them a benefit of doubt, and are getting listed them at a fairly high valuation today as well in some cases. So
Yeah.
there are some companies who are trying to establish a business model. However, there are lots of companies which have a very strong business model, may not be delivering profit today, but have a strong business model, and just because they are kind of gaining scale, uh, it you don't see profitability today, but I think in the next 3-4 years you will see a very large profitability. Which means the answer there is that be very choosy in what you choose to invest in this theme. But I think that uh, opportunity is pretty high. Yes, if you choose your stock well, if you choose your business well, or in fact, if you back the right promoter team in these businesses, I think you can make decent returns going forward. And there are the interesting thing is that because of the market environment today, we as investors are getting lots of new options as new IPOs. So
Yeah.
we are not only stuck with those same 300, 400 companies that we used to look at earlier. but now there are another 10, 15, 20 new companies that are getting added to the list. So that's a good part of the market.
Stock investors that it's not, of course it's good, and the what's very is that analysis, right? Especially with sectors.
Uh, Namrata, could you repeat that question? Your voice was breaking. Okay, so let me take this part till Namrata comes back. I think the question was algo-based trading is uh, slowly. Uh, Namrata, you're back?
Yes, are you able to hear me?
Yeah, yeah, I can hear you.
Okay, so I
I think we lost her again. So let me take this question again. Uh, the algo-based trading is slowly picking up interest in India. How big a role will it play in changing the dynamics of investing in the coming 5 to 10 years? Interesting question, actually. Algo trading, yes, it is picking up pace. In fact, we ourselves as investors, uh, whenever earlier, for example, I remember when I started my career, uh, whenever we used to give an order for buying or selling, the dealer at the end used to punch in the order himself or herself, and it was all manual trading. Uh, and by the time, and it's changing so rapidly, the technology. And I'm not talking of algo, by the way, but more technology wise, I think investing or kind of executing buy and sell orders is moving toward technology very, very rapidly, and it has pros and cons from a market perspective. But the question has implications, or the answer has implications for more short-term traders, actually, because algo trading, algo investing impacts short-term volatility of the market. The inherent value of a business doesn't change. Long-term trajectory of the market, long-term trajectory of the stock price doesn't change at all. However, if you are an options trader, if you are derivatives investor, if you are a trader in the market, cash market, algo trading, or long short funds, uh, uh, all of which use these quantitative formulas, uh, will do have a short term impact on the market. They tend to increase volatility in the market as well at times. But given that I am more a fundamental investor, more long term investor, I think long term value of a business doesn't change. Ultimately, cash flows, profit growth is what matters. So if you are a long term investor, it doesn't matter. But short term, yes.
So are you able to hear me now?
Yes, yes,
Am I
very clearly.
audible? Yes. Okay, good. So just I think one more question, which is on blockchain and cryptocurrencies. People want to know what's going to be the next trend, what's going to be the cryptos are going to play in the next 10 years.
So it's an interesting trend. It's so the way I see it. Earlier, whenever an asset allocation, somebody was doing an asset allocation, a part of his or her portfolio was being advised to be invested in gold. That part depended on one. So this gold investing was largely for hedging your risks, not to make money, by the way. Gold was supposed to help you at times when things go bad in global economies and financial system, and uh, and it held up very well for investors whenever you invested in gold. For example, in 2008-9, in that phase, when we had a financial crisis, gold price shot up. So if you had some allocation to gold at that time, your portfolio to that extent was protected from downsides. What I realize, so ultimately, what does cryptocurrency basically? Why is it becoming more fashionable, or why are people, experts, talking about it? Is that we are all questioning the global financial system increasingly more and more, because the fiat currency system, which is there today, where central banks keep printing new currency, uh, without any collateral from a gold perspective, or without any relation to the economic size. What has happened is that leverage for governments across the globe has continued to move higher. So debt to GDP for all countries globally have continued to move higher. That's how global economies have grown. So there are people who are skeptics and who say that someday this currency ecosystem will change, and a blockchain based currency, which is a Bitcoin and lots of other currencies, they make more sense because there is a limited amount of cryptocurrency that one can issue, because of the way it is designed, and hence there is more value to it. And someday when the currency ecosystem kind of changes, people will maybe graduate toward this part. That's the whole logic to it, which means that people are wanting to hedge their portfolio. So again, coming to the same point, earlier people used to use gold as a hedging. Today, some part of that people are starting to use cryptocurrencies. Uh, Now, my point is, the only point that I have here is that uh, it makes sense, yes, uh, but think about it only as a hedge. If the problem is that most investors or most people treat it as an investment vehicle where they want to make quick money or high returns. That is where the challenge is. I don't think one should take it as a return vehicle, but more as a hedge for your portfolio. If you do that, you allocate small part to it, think long term, remain invested, you'll be okay. But when you, because it's an evolving ecosystem, nobody knows whether it will remain, not remain, how regulations behave. Governments across the world are talking about it. Central banks across the world are thinking of creating their own digital currencies. In fact, China is already testing their currency. India is talking of coming up. Whether that comes or not, we don't know. But it's just that uh, everything is changing or looking likely to change. And in this phase, uh, don't be too much over reliant on this part only. Treat it as a small allocation in your portfolio. Think long term, and take it as a hedge part of the portfolio, and not as a vehicle to make, or not 100% allocation to this currency alone. If you do that, then you're okay. Otherwise, you will face lots of volatility, and someday you will burn your hands as well.
No, I mean, I do believe that eventually, if you have your financial plans in place and you're, investing towards achieving those plans, you will stick to your financial basics, right? You don't have an ambition to go stocks to mutual funds, etc., in terms of asset classes. And I do experiment a small amount with those. At this point, since we are still learning, I think it's fair to not just put a big amount of money in cryptos and maybe burn your fingers later then. And of course, I'm sure everyone will agree with me that when it comes to sectors as well, of course, we spoke about a lot of sectors today, but all of you have to understand that not every company in a sector is going to perform. So you have to do your own analysis. You have to do your basic groundwork before you really decide which company stocks you want to invest in or mutual funds that you want to invest in. So I think with that we can end the session. And thank you so much, Mr. Chandraprakash, for giving us all the beautiful insights that you did on all the sectors. Truly, truly enlightening. And I do hope the viewers had a good time. I do hope it was a learning experience for all our viewers. So thank you so much, everyone, for joining us today. And thank you, Mr. Chandraprakash, for joining us today as well. So take care and have a good weekend, everyone.
Thank you so much, Navrata, for hosting this, and thank you, investors, for joining us on the call today. Thank you.
See you guys. See you. Bye bye.